So by popular request, we're going to look at another very hated stock in 2023, which is Disney. Disney stock is down 6% year to date, but even worse, it's down over 60% from its high in March of 2021. So it's one of the most hated stocks in the market today. Now we know that there are some really hated stocks that can become loved again, like Meta. These are companies where they are going through short-term problems, but the long-term economics of the business remains strong and they have got a wide economic moat. But if the company is facing some permanent issues to its business model and the problems are permanent issues, it will remain hated forever. So does the House of Mouse have any hope of rebounding to its former highs, or is it a permanent problem? Let's find out in this video. So why has Disney stock performed so poorly in the last 2.5 years? It's because of one main issue, and that main issue is the uncertainty of the profitability of Disney's media and entertainment division. You see, Disney has got two main divisions. The parks and recreation business is doing very well, so that's not a problem. It's the media and entertainment business where the profitability has dropped and the future is a bit uncertain. Because Disney is in a transition where it's transitioning from its traditional cable TV model, linear networks, which is a sunset business, into the new direct-to-consumer streaming business. So that's the main issue. Now, before we address the issue, it's important to first of all understand the Disney business model. Now, personally, I only like to invest in companies that have got a sustainable competitive advantage, an economic moat that protects it from competition, that gives it pricing power. So the first question is, does Disney have a wide economic moat? Well, I believe it does. Disney's wide economic moat comes from its brand equity. It's got the most valuable brand in the leisure industry. I mean, everyone loves Mickey Mouse. Everyone knows about Star Wars. Everyone knows about Marvel. These are brand equities that can't be replicated or replaced by anyone else. And it's also got the 7th most valuable brand in the world. Disney's wide moat also comes from the fact that it owns the most diverse, the most wide-ranging amount of intellectual property content that it can monetize, that it can license. And it owns all these brands and companies. So it owns the Walt Disney Studios, that owns Marvel Studios, that owns Lucasfilm, that owns Star Wars, that owns Pixar. They also own companies like ABC Broadcasting Network. They own the Disney Channel, they own ESPN, they own 21st Century Fox, that owns 20th Century Fox, that owns Fox and FX Channel, that owns National Geographic, that owns A&E, that owns the History Channel. So for example, Disney theme parks command 52% market share in the theme park industry and attracts almost 2.5 times more visitors than its next closest competitor. ESPN is also the #1 sports network. Its wide economic moat is unquestionable. So what's the problem with this business? Well, to understand the problem, let's look into its business model. So as mentioned earlier, Disney has got two main business divisions. The first is the Disney Media and Entertainment division, and the second is the Disney Parks and Experiences and Products division. Let me talk about the second one first. Now, the Disney Parks division would include the Disney parks, the Disneyland parks in Florida, Tokyo, Shanghai, Hong Kong, Paris, California, and the Disney cruise lines. And of course, all the consumer products like the Disney toys, merchandising, games, and so on and so forth. Now, the second division, Disney Parks and Experiences, is doing extremely well. Revenue is growing double digits, profits are growing double digits. So in fact, that is driving the profits of the entire company right now. Now, of course, Disney Parks had a short-term problem during COVID. In fact, the business went almost to zero when all the parks were shut down back in 2020. But ever since then, this part of the business has rebounded extremely strongly. So that's not the problem. The problem is in the Disney Media and Entertainment division. So what's the issue? So for many, many years, Disney made a lot of money in this division from its linear networks business. Linear networks is their traditional cable and satellite business. So for example, when you watch your cable TV or satellite TV that is operated by Comcast, AT&T, Charter Communications, Verizon of international markets, you've got your own local channels. And they run like the ABC TV network, Star TV, Disney Channel, FX Channel, ESPN Channel, National Geographic Channel, right? So whenever you watch all these TV shows, Disney makes money from licensing fees and advertising sales that they earn through their cable and satellite operator partners. So this part of the business is very profitable, and it's been very profitable for the last 20, 30 years. Now the problem is this linear networks business, the traditional TV business, is in a sunset industry. It is declining slowly. Why? Because people now are watching less and less paid TV. They are now changing their media habits and now watching things online through streaming, right? So what has happened is Disney, they know that this is still profitable, but this is a declining sunset business. So since 2019, they have decided to focus to transition into the direct-to-consumer business, which is a streaming business, which is their Disney Plus, Hulu, and ESPN Plus. Now, the problem is this part of the business, which competes with Netflix, this part of the business is not yet profitable because it takes time to reach a certain scale to become profitable. So because the last 2.5 years, they're in this transition where this is kind of like making money, but making less money every year because it's a sunset industry. But this business, the streaming business, is not yet profitable. And that is why their profits have been falling temporarily in the last 2.5 years. And that is the main cause of the share price fall. So the most important thing we're going to look at is, can this part of the business, can the streaming business eventually become profitable and begin to make up and exceed the profits that was generated by the traditional cable TV business? That's the whole crux of it. So let's take a look at the financial statements on gurufocus.com. Now let's begin with revenue. What is good about Disney is that the revenue has been growing consistently, even with the shutdown in the parks in 2020, even with this transition to the streaming model that is unprofitable, but revenue has been growing consistently even the last 3 years. You can see that over there. So that is a very strong point for Disney. So it's not the revenue that's the problem, it's the profitability and the free cash flow that has gone down in the last 3 years, right? So you can see in green is the net profit, and net profit again has been very consistent over the years. In green, as you can see, profit only plunged in 2020 because of the pandemic when the parks were all closed. But again, that has rebounded very strongly. And again, in 2019 was when they started to shift to the streaming model, and it incurred a lot of expenses, and streaming again is not yet profitable, and hence it has been having very low profits and profit margins in the last 3 years. What's more important than profits is free cash flow. If you look at free cash flow over here, in blue, right, in blue you can see free cash flow has been increasing very consistently, and it only plunged in 2019 in blue, right? So it went down here, and then 2020 it went negative, 2021 positive again, 2022 still positive but went down. So this is when free cash flow became a bit inconsistent. Now, as you guys know, my criteria when I invest in a business is I want to make sure the business has consistent growth in revenue, net income, and free cash flow for at least the last 5 years. So on the surface, Disney fails my first criteria. However, if revenue is still growing, but is the profit and the free cash flow that has gone down in the short term, I ask myself this question: is it a temporary issue that can be resolved? If it can be resolved, it's a short-term issue, then it could be a turnaround situation. So I will invest in a turnaround company if I believe it can turn around. But because of the uncertainty, I would invest a smaller allocation versus a normal business that is consistently growing its profits and free cash flow. Now, having said that, I already have a position in Disney, all right? I already have a position, and it's a smaller position because it's a turnaround situation. So do I believe it can turn around? Well, if I didn't believe that, I would sell all my shares right away, okay? So the reason I'm still holding my shares, I may add a bit more, is because I believe that it can turn around because, again, Disney still has this wide economic moat, and the moat is not deteriorating. I think the moat is still very, very strong. And these issues can be solved in time. But the only question is, how soon can it be solved? And has it turned the corner? Let's take a closer look, all right? Now, what's good is that if you look at the again, the free cash flow, you can see that before it started going down because of the transition into streaming, which is unprofitable so far, and before COVID, you can see the free cash flow of Disney was growing every year, and it hit a peak of, let's see, $9.8 billion free cash flow in 2018. So we want to get back to that level, that pre-business transition level. Now, the good news is that if you take a look at the quarterly data, you can see that Disney looks like it has begun to turn a corner where the free cash flow is beginning to grow again. Let's take a look. So if I go to quarterly data, let me just click on quarterly data. And again, revenue is not an issue. Revenue has been growing, right? It is the free cash flow that's the issue. So you can see that the last 2 quarters were here, right? This is this quarter and this quarter, okay? So in this quarter, which is the most recent quarter, free cash flow came in at $1,637 million, as you can see in that table. So $1.637 billion. Let me write this down, right? So 1,637 million. That is in this quarter over here, yeah? And the quarter before that, let's put our mouse and let's take a look. What was the free cash flow? Free cash flow was 1,987 million. Let me write this down. 1,987 million, right? So these were the last 2 quarters of free cash flow. Now, if you believe that they can maintain this free cash flow and in fact even grow the free cash flow from here, then you can annualize the last 2 quarters, which means if you take the last 2 quarters and you multiply by 2 to get a 12-month annualized figure, what do you get? Let's see, you get 1,637 plus 1,987. That's 3,624 million or 3.6 billion, right? So multiply by 2 to get 12 months. That gives you 7.248 billion. Let me just write this down somewhere, right? So if you multiply this by 2 to annualize it, that's an annual free cash flow projection of 7,248 million. Now, if you go back to the annual data, you can see that if they can produce $7 billion of free cash flow, that will be somewhere about here, right? So again, of course, it's not straight away back to the 2018 level, but at least it's back to about the 2015 level. And then from there, if it can grow again, then that the share price can definitely rebound. So do I believe that they can grow their free cash flow from here and they can get at least 7 billion of free cash flow in the next 12 months? I think it's very, very possible because their streaming business, which is the unprofitable business, has been narrowing its losses for 3 consecutive straight quarters and is projected to turn profitable by next year. And management is going to raise prices of their streaming business and they're going to cut costs aggressively. So that should accelerate the profitability of the streaming business. The linear networks business remains profitable, although the profitability is declining a bit over time. And the parks and recreation business is growing double digits. So if all that comes into place, then we should have that free cash flow growth from here on. So I think that Disney may be turning a corner with that. So if Disney can produce this free cash flow, then what are the shares worth? And are they worth buying at this level? So let's plug it into the intrinsic value calculator. And again, if you enroll in the value momentum whale course, you'll get all these proprietary tools that I use. And of course, if you're too lazy to calculate it yourself, subscribe to UIP, where I do valuation of all the stocks in my portfolio, in my watch list, and you get a deep dive research to make your own investment decisions. And you also get my live buy and sell alerts, as well as option trades on a daily basis. So having said that, let's take a look. So using a discounted free cash flow valuation method, you can see that I plugged in the free cash flow at 7.248 million. So recall that this 7.248 billion in free cash flow is based on the last 2 quarters. And we're going to analyze it moving forward, assuming they can continue to sustain or grow this free cash flow. Total debt of Disney is currently 46 billion in total debt. So they are slightly a bit more leveraged than other companies. That's something to take note of as well. They've got 11.45 billion of cash and investments. Now, what is the growth rate that we can use to project the business going forward? So what I've done is I've put in the growth rate of 18%, given it's a turnaround situation. I'm going to put it in for the next 10 years. This is based on an average of the various websites, Capital IQ, Finviz, Zax, and Guru Focus, taking an average that's about 18.33% growth in the next 10 years. And then tapering off at a 4% growth rate terminal value. Company has got 1.83 billion shares outstanding. I'm using a 6.6% discount rate based on their beta of 1.29. So that gives me roughly an intrinsic value of $152. About that, right? So that's my intrinsic valuation of Disney. So current share price now is $83.36. So 83.36, that's about 45% discount to valuation. So at today's share price, it gives an investor a pretty good margin of safety. Now again, you could of course plug in lower growth rates. If you think that, for the next 5 years, I'm going to still cap it at 15%, which is what I usually do. You're going to be more conservative, put that at 15%. Then that gives you an intrinsic value of 135. And at 83, it's still 38% undervalued, right? So again, the growth rates you use are really up to you. You want to be more optimistic, more conservative, but the good thing is even if you plug in a more conservative growth rate at today's share price, it's still a margin of safety. Now let's take a look at the latest earnings results that came out on the 9th of August. Now initially when the results were announced, Disney shares actually rebounded, but then they lost its momentum because of the weak bearish period that we're in right now. Also, it doesn't help that there's a writer's strike in Hollywood and there's this ongoing political feud with Disney in Florida with Ron DeSantis. And some recent Disney-owned movies also flopped at the box office, like Indiana Jones and what's the other one called? Elementals and Little Mermaid, right? So all this adds to the negativity towards the stock in the short term. But I think they're all very, very short-term issues. Okay, but let's take a look at the earnings results. So again, you can see that overall, revenue grew. That was great, right? And free cash flow grew. And if you actually zoom in, you can see again, in terms of revenue, let's look at revenue. You can see the 2 divisions, right? So the Parks and Experiences division, like I said, very good, grew at 17% over the last 9 months, right? Revenue grew 17%. And operating income at their Parks and Experiences grew 20%. And that's why I said their Parks and Experiences, no problem, doing very well. In fact, it's carrying the business right now while it's dealing with this kind of like transition in the Disney Media and Entertainment division. So this division, you can see revenue only grew 1%, right? And the operating income fell 46%. From 9 months ago. So this is still the problem child that needs to turn around. Now again, where's the issue coming from? From this media and entertainment division. Let's take a closer look. Right. So like I told you, the linear networks division, that is their legacy TV business. It is profitable, but it is a declining sunset business that they slowly want to rely less on. All right. So revenue at the linear networks business fell 6%, which is understandable, but still profitable, right? Came in at about 4.9 billion in operating income, but again, the operating income fell 27%. So like I said, sunset business. So it is this business, the direct-to-consumer, the streaming business, that's the one that needs to take over and needs to become profitable. Now, the good thing is that their streaming business grew 12% in terms of revenue, and their operating income still losing money, but losing less money, right? So they're kind of like reducing their losses, and they again should turn profitable by 2024. Okay, losses so-called went down by 12%, so that's a good thing. So let's take a closer look at the direct-to-consumer streaming business. So again, remember, this includes Disney Plus, ESPN Plus, and Hulu. And you can see that their operating loss has been slowly narrowing to now only $500,000 loss in Q3 of this year. This is compared to a $1.1 billion loss 1 year ago. So management is projecting that their streaming business will turn profitable by latest 2024. But the good news is that they're going to raise the price of Disney Plus and Hulu in October. They're going to cut costs aggressively. So if they do that, then it should turn profitable a lot earlier than what they initially projected, right? So again, Disney has narrowed its losses in this segment for 3 quarters in a row, and the trend is there even before the subscription price kicks in. Now, another cause of concern that investors have that's making them jittery is that Disney subscribers have been falling slightly, especially in the domestic US market. So over here, you can see that in the last quarter, Q3 2023, they had 46 million domestic subscribers. So if you compare that with the last quarter, it was a drop of 300,000 subscribers. So that's not very good. But if you compare with 1 year ago, it's an increase of 1.5 million subscribers. So quarter on quarter, subscribers have fallen, but year on year, it's still risen a bit. Okay. However, US ARPU is the average revenue per user. The average revenue per user has increased by 17 cents versus the prior quarter, as well as versus the prior year because of higher advertising revenue per subscriber. So although subscribers have fallen, revenue went up because the revenue per subscriber went up. Okay, but for international subscribers, you can see that 59.7 million versus last quarter 58.6 million. So it grew by 1.1 million quarter on quarter, and versus 1 year ago, it grew 10.5 million. So international subscribers growth is pretty healthy. It's the US domestic subscribers that have softened slightly. But overall, Disney Plus core subscribers have increased both quarter on quarter and year on year. Now, do note there's also the Disney Plus Hotstar subscribers, which are in India and Southeast Asia. Now, that had a drop as well for the last 3 quarters, but mainly because of a big drop from the Indian subscriber market, because Disney Plus lost the license for the Premier League cricket matches. So moving forward, what is going to drive Disney's increase in profit margins back to its past levels, back to a very profitable and high free cash flow level? So a few things. Number one, management is going to raise the price of their Disney Plus streaming subscription. So the Disney Plus, that includes Star Wars and Marvel, National Geographic, they're going to increase the price from $11 to $13, a 30% price increase per month. And their Hulu subscription going to increase by 20% to $17.99. This is from October of this year. So by raising their price, that would be a big increase in their profit margins as well as their profitability. Okay. Now, by raising price, will they likely lose some subscribers who can't afford to pay? Yes, they could lose subscribers, but by raising their price, overall revenue should still go up. They're also going to crack down on password sharing, just like Netflix. So now you can easily share your Disney Plus account with your friends, your neighbors. Once they crack down on that, then those freeloaders would have to get their own Disney Plus account if they want to continue watching. Now, when Netflix cracked down on password sharing, what happened? Their subscribers increased because people had to subscribe. They couldn't get it free of charge anymore. Okay, so I do expect that the combination of them raising prices may lose some subscribers, but they should also gain subscribers once they stop the password sharing. So net, subscribers should remain or grow, and overall revenue should increase. Okay, now plus they are going to cut cost aggressively in two ways. So their management is planning to cut 2.5 billion annually from their operating as well as their administrative expenses. So this will likely come from headcount reduction and cutting back on low efficiency marketing expenses. So this is what Amazon and Google and Meta did last year. They were over bloated. There was too high a headcount. It was inefficient, it was unproductive. So they fired a lot of people. They cut the fat, became a lot more profitable. So Disney's going to do that, and that should add 2.5 billion in profits and free cash flow per year. Plus, they are also planning to save up to 3 billion annually in content production and related spending. So management has recently acknowledged that they are spending too much on creating too much content that may not be of high quality. So now they are thinking it's not quantity, it is quality. So they want to produce less shows but higher quality and with a more streamlined budget. So by doing that, they should be able to save an additional 3 billion annually. So 3 billion plus 2.5 billion, that's an additional 5.5 billion in savings that goes to your bottom line. So if they can pull this off, Disney can go back to its very, very profitable past, and that should really cause the share price to re-rate upwards. So is Disney a very safe, sure bet investment? No. It is a turnaround situation. So a lot depends on, can they execute their plan? If they can execute their plan, yes, Disney will become very profitable again, and the share price can easily, double or even triple from here. But again, there's the question, can they execute? Can they pull it off? That is always an uncertainty. But the good thing is that at today's share price of $84, you've got a pretty good margin of safety. So even if they screw it up, even if they don't get back to where they were fast enough, I think there's pretty limited downside. So the risk to reward looks pretty favorable. Now, of course, there are other things that you must consider. Remember that right now, their parks and recreation business is doing very well. If the US or globally we go into a bad recession, the parks and experiences business will get hit as well. So Disney is a moderately cyclical business. It will be affected by the global economy if a recession hits. So that's something you got to think about as well, okay? So again, if you look at the charts, you can see that base case valuation is about 152. If you take a more conservative valuation, it's about 135. So that's the valuation range of Disney. Right now we're at $83. So we are now undervalued, and it's got a pretty good margin of safety. Now, from a fundamental perspective, barring any unforeseen events, I think there's very limited downside right now because I think the shares are very attractively priced. Even if the streaming business doesn't turn profitable in the very, very near future, even if it takes another year to turn profitable, I think it's a very attractive level right now. From a technical perspective, I think that there's also a very limited downside because usually the market will tend to bottom using a double bottom pattern, like a bear trap pattern. So it could make a double bottom at this level right here, or even if it breaks below this bottom, I think at the most it will retest the COVID low, which I don't think it will. So I think that this could potentially be very, very near the bottom, right? So the question is, how do you take an entry as an investor? Now, if you just want to be pure Warren Buffett fundamentals, you just add right now. Don't even look at the technical analysis, right? Just add, or you can do a dollar cost averaging approach. But if you want to also take into account the technical analysis, then you can go to, for example, the daily candles right here. And you can clearly see that it's on a downtrend right now, making lower highs and lower lows. The 50 moving average below the 150 moving average. Moving averages are sloping down, and it's also below the 200-day moving average. So there are some people who say, I only want to start buying when I see a confirmed uptrend. Yeah, sure, you can do that. So wait for the 50 moving average to cross above the 150 moving average and for them to start sloping upwards. Or wait for the price to get above the 200-day moving average and the 200-day moving average slopes up. You could do that. But if you wait for confirmed uptrend to start buying, then of course you'll be buying much higher, probably at about 115 level, which is okay. It is still undervalued, so nothing wrong with that. Yeah. If you want to be a bit more aggressive, like what I would do would be, even before an uptrend, I would start to build a position if I see a potential reversal pattern. When I see a reversal on the downtrend pattern. So usually that happens using a double bottom pattern, bear trap pattern. Some of you would have learned in the price action manipulation course run by Alson, right? So again, this was a previous swing low and it just broke below that previous swing low. So the question is, could it close back above that swing low? If we see that the price is able to close back above this swing low in the next 4 to 5 days, if you can close back above that with a bullish candlestick pattern, that could be a potential early entry, right? But if it doesn't close back above this in the next 4 to 5 days, then yep, it may go down to retest the COVID lows, at which point you have to wait for a double bottom pattern to form at that level. So many ways to enter depending on your style of entry. Again, Warren Buffett style, just add without looking at the charts, or wait for a double bottom reversal pattern, oversold conditions, or wait for confirmed uptrend. So in summary, Disney is a company with a wide economic moat, so it's not going to go away anytime soon. Shares are also at a pretty undervalued level, giving a pretty good risk to reward ratio and a good margin of safety. But for the share price to rebound back to intrinsic value and new highs, the management must convince investors that it can stabilize its subscriber base and is able to turn its streaming business profitable, or at least show that it's going to turn profitable really, really soon. Now, of course, like I said, there are risks to this investment. If a recession hits, it's going to affect Disney's business because it's a consumer discretionary, high-priced business where people are going to cut back on their spending on the parks and recreations and streaming. There's also, of course, a risk of the writers' strike extending far beyond now the 100th day. So if that extends, that could also affect their business. So there are a lot of uncertainties in this business. It's not a truly 100% predictable business right now. There is a turnaround element to this business. So that's why as an investor, we want to take only half our normal allocation given this extra uncertainty. So hope you enjoyed this video. Stay tuned for the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.